Hello everyone and welcome to another financial analysis video, and today we are going to be looking at a company called TEK Capital. So TEK Capital, what do they do? Here it comes. They are a unique IP investment company. They acquire and commercialize technologies developed by a global university network. The technologies bring to market evidence that ethos interested in new innovations that can improve the quality of life of the customers they serve. So this is very much about working with universities and helping them to commercialize some of their research and development. Now this analysis is a result of a request, a chap called Dave. So here you go, Dave, who recommended a number of different companies, some of which we've done, and here is another TEK Capital. So once again, do like, share, subscribe for this channel, and do feel free to leave any comments in the comments box. Also, if you are using this as part of investment research, fundamental investment research, do remember that all we're doing is just looking at the financial statements. We're not looking at the market, the competitors, the growth of the market, or the opportunities. That's other research which you would need to do yourself. So this is really just giving you a quick insight into the financial statements and the numbers that are contained therein. So with that in mind, let's jump straight in. Here is TEK Capital, and we are going to look at the numbers. So nice glossy brochure, and we have to scroll all the way down to find their financial numbers. And the consolidated income statement is available here on page 38. So here it is, and we see the revenue. So quite interesting here. So we've got the revenue from services of, and this is in dollars, you'll notice, is just over $1 million. So it's about $1.2 million. And they've also got some unrealized profit on the revaluation of investments. So this company effectively is making lots of investments, and it is saying that the value of these investments is going up, and these are increased by about 8.7 billion. So that's a little bit of a kind of a question mark, because that's it's unrealized. You really don't know what something is worth until you come to actually sell it. But what I'm interested here is that while the revenue is very high, it's good to see that the cost of sales is considerably lower than the revenue from services. So that revenue from services, that's physical cash flow coming into the business, the cost of sales, and so they are operating at a gross profit. And even if we eliminate the unrealized profit, this bit here, we still get a trading profit. However, the administrative expenses are quite high, and therefore they need this revaluation in order to be able to pay for those administrative expenses. So what we're going to see here is we expect a company which may be profitable, but is probably cash flow negative. Further down, you'll notice a big gaping hole here. There's no interest. If there's no interest, it means they are paying no tax. So it is profitable, but most of that profit is due to this unrealized profit on the revaluation of investments, and that is a big question mark until we actually come to realize that profit. Let's go into the balance sheet and see how strong they are. So we see up at the top the non-current assets. These are the things we need to run the business, and easily the biggest number is that investment book. So you'll see the investment book, and it's gone up by that 8 million or so. So really they're sitting on 30 million of investments, and they will 30 million of investments, but this is unrealized. We don't know exactly what they're worth until you actually take it to market. In terms of the current assets down here, these are the things which are either cash or going to become cash quite soon. They're sitting on about $500,000 worth of cash. So that looks like it's quite a lot of cash. We'd have to look at their cash flow statement to see whether they've got sufficient cash if they are cash burning. Bottom half of the balance sheet, we see the liabilities. So first of all, the current liabilities. Here are the current liabilities, things we have to pay soon. Now, what we notice in what we have to pay soon is the two big numbers. This is trade and other payables. So this is what we have to pay to our suppliers, and this is what we've got to pay it to with. So they've got $1.2 million of things which are cash or going to become cash soon. They owe 200, quarter of a million dollars. So liquidity doesn't seem a real problem. This deferred revenue, this is not actually an amount that is owed. This is a liability, but this is cash they've received today, but they're not allowed to show it as revenue until next year. So they've received it in this year, it relates to next year, and therefore they have to show it as owing to next year. So they're not going to have to pay it out, they've already got the cash in. And that suggests to me that they've got reasonably strong cash flow because they're getting money in upfront for their services. So again, we'll find that out when we get to the cash flow. So down the bottom, what do we see? Here is the investment by the shareholders. So that's about nearly just shy of $14 million invested, and then the retained earnings here. But this retained earnings, I think, is mainly the revaluation of those investments. So they've raised some money, they've invested in underlying this IP. That is then being revalued up. It's an unrealized, it's effectively mark to model, or so it's going to be a mark to their model. They'll have a model that estimates the value of that IP. That is going up in value, and that's why they have this positive balance sheet. So the balance sheet is pretty significantly positive, which is good, but it is based on what your valuation of that unrealized IP is. Movement in equity is not a lot going on because they're not paying out any dividends, so they're just taking in those revaluation, and here we can see pretty easily. So the profit for the year, and those profits are driven through the revaluation of the investments. And then we come on to the cash flow, which is pretty important. So the net cash flow from operating activities, we see they've got negative cash flow. Okay, so it's less than it was the previous year. So they're 1.4 million negative cash flow or cash burn. This time they're just under a million, so it's a million cash burn. They are buying additional assets, so they're investing in sort of new products, new IP, new ideas. So those are the and they're funding all of this through the issue of shares. So existing shareholders are being diluted. They're investing in this IP. They're saying that the IP is going up in value by about $7 million, for example. But the proof is in the pudding. It's only worth it when you actually bring it to sale. And so we can see that if you've only got $500,000 in the bank, and if you've got $500,000 in the bank and you're burning at about $1 million a year, then you're going to have to go back to the market and raise some more money. So we'd expect these guys to be back in the market, raising additional capital in order to fund their business. So here we see a statement on the going concern. So we notice that that cash burn is a bit of an issue, and therefore they've actually made a statement on the going concern. They talk about sufficient cash reserves to operate at its current facilities, and they would seek to raise additional funds through equity issues. So there's no debt in this company. They're looking to raise money, and that's what they would expect to do. They'll be raising money in order to make additional investments. So they are operating very close to break even, not quite, but what they're looking to do is to kind of raise additional cash for some of those future investments. So quite interesting looking at the revenue recognition, and note 2.9 actually talks about the revenue recognition. You'll notice here that the group, they make a statement that the group uses valuation techniques appropriate to the circumstances for which sufficient data to measure the fair value. So what they are, they're measuring the fair value of their investments, and they are revaluing them accordingly. Now, usually a company wouldn't recognize revenue, wouldn't show unrecognized revenue through the profit and loss account. It would only show recognized revenue, i.e., when they've actually made the profit. So it's just to kind of flag that up to any potential investors, that that is a potential a thing to be aware of. So let's see. Let's go to the valuation of the company, so the market valuation, and see. So being fairly rocky ride, you can see, since they floated back in 2000 and whenever that was, about 13 or 14. It's been bouncing around quite a lot. It's been rising since 2019, which is good. So the P ratio, quite interesting here. The price to earnings ratio 2.89. That suggests a yield of 50%, which is very, very big. Really what that's saying is that the earnings, because the earnings are unrecognized, you've got a distorted figure there. So, usually that would be a screaming buy that says this company is very, very cheap. You should be buying it because you're going to get your money back in 2 years. And again, if you're buying into the revaluation methodology, then, maybe that's something which you would like to consider. Market cap 25 million, compared with a net asset value. So the balance sheet is 32 million. In fact, these guys are trading at a discount. Okay, so what's interesting here is that the market value of this company is less than the actual breakup value. So just to reiterate what I mean there is that when we look at the balance sheet, and here is the here is the balance sheet of the group. So here's the balance sheet of the group. So the balance sheet of the group, the net assets, which is the same as the shareholders' funds, is 32 million. So in theory, and I do emphasize the word theory, in theory, if you were to buy this company in its totality, and you were to pay the market value of 25 or 26 million pounds, or $1 million, sorry, you pay $26 million, and then sell the individual assets for 32 million, you'd obviously make some money. So this company is, again, I'm not giving investment advice because I'm not qualified to, but it looks to me like it's trading at a discount to the underlying valuation. It's got a very low P ratio. It looks to me like if you buy into the company's method of valuation, if you understand the underlying IP, then it looks to me like this could be a very good opportunity to buy a company which is relatively cheap, and looks like it's got a little bit of momentum upwards in terms of its share price. So there's my financial analysis. Don't forget, we are just looking at the financial statements. If you've got any comments, then please do leave them in the comments section. Please don't forget to like, share, and subscribe to the channel to receive additional notifications of other financial analysis. If you are interested in this company, do take time to read through the financial statements, read through the strategy, the board, read through the types of investments they've made. Make sure that you buy into the story, that you understand the market, and you understand the risks that you are taking. So thank you very much for taking the time to watch this, and good luck.